All we have is this giant IRA or 401k, and every dollar we pull out, we're going to get taxed.
Sure.
That could cause us to bump a tax bracket. That could cause us to pay more tax on our Social Security, right? Double taxation. We pay the dollar out of the IRA, and we also pay up to 85 cents on Social Security.
Wow.
Double taxation.
Ouch.
I don't like it when we don't have flexibility.
Sure.
So ideally, and I wrote about this in my investment letter, not my newsletter. My investment clients get an investment letter every month. So last month's topic was just this. You should have 3 pots of money, ideally, in retirement.
Welcome to today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Anchored in family values, Wayne offers practical advice to help you get the most out of your retirement years. For more information, visit today'sretirees.com. Now, here's your host.
And welcome to today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. We are glad you are with us today. We've got a little problem with the device.
Timer wouldn't start.
Device on I've been watching Wayne smack that thing now. We've got ready to throw it out the window. No, every time, we're in a new year. We have a new administration. Love it or hate it. I know people, everything's polarized today. Mm-hmm. But we're going to talk a little bit about taxes. We know through history, every time an administration changes, so does the tax code.
Yes. It's like, we plan for one thing, and
right.
However many years later, we got to go back to the other thing. And not just taxes, but many things.
Right. And that makes your job very interesting, I can imagine, trying to figure out for families how to control their tax burden.
It's one of the things that keeps me relevant.
Right.
So, it's a ebb and flow, and especially now with all the government borrowing and spending and stimulus packages. I mean, the debt in this country is
staggering.
Off the charts. So that's going to affect all of us at some point.
Mm-hmm. So when we are dealing with, the program is called Today's Retirees. You work with families, primarily 50 and above, those that are planning for or are retired. That's your target. That's who you're looking for.
Yeah.
That's who you work with. So how does a family, knowing that this situation is always fluid, how do we control our tax burden? Or do we even care?
Well, most don't control it.
Okay.
And that's one purpose of today's show.
That's the problem, huh?
You should.
Okay.
And most don't change their approach. One of the biggest mistakes I feel people make is when they're saving throughout their years, their working years, saving up through retirement, is they get in the habit of trying to pay less tax every year. So one of the easiest ways to do that is loading up their IRA contributions, HSA contributions, 401k contributions, 403b, 457, whatever retirement plans available at their work. They put as much money as they can in, so they get a tax deduction on the contributions, and they have a lower tax bill at tax time. So why is that a mistake, do you think?
Well, only because I've been with you for so many years.
Right.
I forget the gentleman that said it, but we want to tax the seed and not the crop.
Maybe.
Oh, well, see, that's why he does this.
Yeah, well, maybe. It depends on, and the reference to seed and the crop. When you put money into a Roth IRA, right, you're not going to get a tax deduction.
Right.
You're going to pay the tax on that contribution.
Right.
If you're over 50, it's like $7,000 now. You put $7,000 in a Roth, you're going to pay the tax on the 7, just as if you didn't do a Roth or you put the money in the bank, whatever, you're going to pay the tax on the 7. But when you withdraw the money at some point in the future, it's all tax-free. It grows tax-free, you get to withdraw it tax-free.
Sure.
So you paid the tax on the seed the crop, whatever it grows to down the road, is tax-free. When you pay tax on the crop, you get a tax deduction on the seed. So when you put in a traditional IRA, you put the $7,000 in. If you're over 50, you're going to get a tax deduction on the 7.
Sure. Okay.
Right. So if you're in a 10% tax bracket, you're going to save $700. If you're 20%, you'll save $1,400 right now. Right. But that money all grows tax deferred, no tax year to year to year. But when you pull it out, whatever that amount grew to, you're going to pay tax on it. Okay. So you're going to pay tax on a larger number. If you do IRAs, you're going to pay tax on a smaller number, the seed, if you do a Roth.
Okay.
So would you think you'd be better off paying tax on the crop versus the seed? It makes sense, the seed, right?
Sure, that's what my common sense tells me, but I'm thinking we're going a different direction.
Well, there's things involved. How much money you're making now, what you're likely to make, and what tax bracket you are in now versus in the future.
Okay, sure.
So I agree. I think in most cases it makes sense to pay tax on the seed, the Roth contribution, including Roth 401k, by the way, and taking the hit, pay the tax now, and especially in today's times, because we are in historically low tax rates right now.
Sure.
They've typically never been lower.
Right.
If you're a married couple and your income is average income, you're in a 10 to 12% effective bracket or even less. That's pretty darn low.
Sure.
So why would you load up a 401k or IRAs, regular IRAs, instead of Roths? Why would you do that when you can get the tax paid out of the way at historically low rates?
Sure.
Versus likely everyone feels taxes are going to go up. Not just because of a current administration or anything like that, but just because the country is in trillions and trillions and trillions of dollars of debt. Right. So everyone's talking about eventually raising taxes.
Okay.
So why would you take a tax deduction in today's times by doing traditional 401ks, loading them up, versus doing Roth or that type of thing?
Sure. Well, to me, that makes perfect sense because, as you said, we are fairly certain that the tax rates are going up.
Yeah, I mean, it's not guaranteed, but it's, if you're a common sense person, they're going up.
Right.
And, Trump went out of his way to put the new tax rates in effect against even many of his own party, but we've had great tax rates for the last, 4 or 5 years.
Right.
But still people were loading up 401ks and IRAs. I mean, it makes sense because they don't want to pay that tax now at tax time. The accountant says, hey, if you put $20,000 in your 401k, you're going to save, $4,000.
Right.
Versus if you put it in your Roth 401k, you're going to pay an extra $4,000.
Right.
So what do? They load up the IRA and don't even think about future taxes.
Sure.
Which could be a mistake.
Absolutely. Now, friends, this is why Wayne does what he does. He helps families. Family-focused retirement planning is what he does. This is and tax planning. He helps families put together a plan. Your plan's different than my plan, different than your neighbor's plan, because every family has its unique characteristics. The way you can get a hold of Wayne is 2 ways. Go to his website, todaysretirees.com, todaysretirees.com, or pick up the phone at 866-626-3990. We'll be back right after this.
So we've all heard the word rollover when referring to an investment account at work or your 401k, your 403b, your 457 plan. What do you do with that when you've left your job and your 401k or other retirement plan is still at your old employer? Or what if you've retired? One thing you don't want to do is you don't want to leave your money, your retirement account, in your employer's 401k. Quite frankly, your old employer or current employer is the boss of your retirement account. So if you have questions about what to do with your rollover, you roll it to Wayne. Get it in your own hands where you have the whole universe of investments and choices, not just what your employer tells you can pick from. So contact my office for a free consultation on how to roll over your old retirement account. A certified financial planner is a true professional, a well-rounded, holistic planner that helps you in all areas of your financial life. Estate planning, tax planning, financial planning, insurance planning. We have to sit for a 10-hour, 2-day exam, at least back when I took the test. It's not just a weekend designation where you go somewhere for a couple days, pay a couple $100, and now you have letters behind your name. One thing I think is important is that you try and find a independent certified financial planner. Somebody that doesn't work for a big firm. I myself own my company, Great Lakes Benefits and Wealth Management. The buck stops with me, an independent, certified financial planner, one of the only ones on the north coast of Ohio.
And welcome back to today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Today we're talking about our favorite topic that everybody loves, and that is taxes. What's the old saying? There's nothing certain except death and taxes. Mm-hmm. We are all paying taxes.
Unless you have a young family and have a lot of kids, so you have all the child tax credits, you know. Yeah. But those days end at some point.
Well, you know, speaking of that, I read a thing, this has been a couple of years ago, that, 40-some% of American families pay no federal income tax?
No, it's higher than that.
Oh, is it really?
Yeah. Yep.
That just blows my mind. I think everybody should be in the game, because we're all part of America, right?
Yeah. I mean, the burden, comes with the higher wage earners and people that, have a lot of money. What we're talking about today is saving in 401ks and IRAs in that. You save a big pile into those types of accounts, and once you start taking the money out, you have no more tax breaks, and you're going to pay taxes.
Sure. So when we talk about that, should we be concerned, you're talking about taking this money out. I mean, there's this graduated tax bracket thing, like we said, if you're younger and you're working and you got,
tax credits, which are like gold.
Right. You got a van full of children that, well, your tax bracket is probably pretty low, I would imagine.
Zero.
But if you are
close to it,
70 years old and you've saved well, and, maybe you're a business owner, you're a farmer.
Or by that time, maybe a widow or widower.
Sure.
Then you get clobbered.
Okay. Absolutely
clobbered.
So is there a way to help in that?
That's a great question. Did you look at my next talking point?
I did not.
Oh, okay. So, and this is a mistake that I see time and time again, and that is people loading up their 401ks and IRAs, all the types of retirement plans that are available depending on where they work, and trying to get as much tax savings today as they can. Okay. Which in the previous segment we talked about, should we be doing that? Should we be doing Roth 401ks, Roth IRAs instead? Now, ideally, in retirement, I teach my clients, if they come to me early enough. See, a lot of people come to me, they're already retired or going to retire or at the end of their working years. So we don't have much time to set things up. We work with what they have.
Sure.
And generally, it's plenty of money, but just money we can't tax plan with.
Sure.
Because it's all in accounts that have never been taxed.
Okay.
IRAs, 401ks, 403, those things. They've never paid tax on it because they've taken those tax deductions all through the decades. Well, now we need money in retirement. We got to subsidize their income, make purchases, do whatever, or even take RMDs out when we reach a certain age, which is 72 right now. It's a required minimum distribution. All we have is this giant IRA or 401k, and every dollar we pull out, we're going to get taxed.
Sure.
That could cause us to bump a tax bracket. That could cause us to pay more tax on our Social Security, right? Double taxation. We pay the dollar out of the IRA, and we also pay up to 85 cents on Social Security.
Wow.
Double taxation.
Ouch.
I don't like it when we don't have flexibility.
Sure.
So ideally, and I wrote about this in my investment letter, not my newsletter. My investment clients get an investment letter every month. So last month's topic was just this. You should have 3 pots of money, ideally, in retirement. You should have money that's never been taxed. Those are the 401ks and IRAs.
Okay.
We get our tax deductions along the way. You should have tax-free money. Those are our Roth accounts, Roth 401ks, Roth IRAs.
Okay.
And you should have after-tax accounts. And these are just like a joint or individual account. They're called non-qualified accounts. IRAs and that, they're called qualified accounts.
Okay.
After-tax accounts are non-qualified. So there's no retirement rules, 59 and a half, RMDs, none of that. It's just money that is after tax. And you can have brokerage accounts like that.
Oh, I see. Okay.
TD Ameritrade, E-Trade, Fidelity, whatever. They don't have to be IRAs in those types of accounts. Just a regular joint account if you're married.
Mm-hmm.
And you could have stocks and bonds and all types of stuff in these types of accounts.
Okay.
So you have a pot of money that's never been taxed. You got a tax-free pot, and you have an after-tax pot.
Okay.
The after-tax, all we got to worry about are dividends annually or capital gains when we sell. And as you know, we talked off air, capital gains rates are at lower than ordinary income tax rates. That gives us flexibility for setting up income streams in retirement, for making withdrawals to make purchases. Where do we go get this chunk of money we need? Do we go to the IRAs that have never been taxed, the Roths, or the after-tax? And when you work with a good CPA, like I preach over the years, it's important that your CFP, Certified Financial Planner, works with a good CPA.
Sure.
So we know the tax consequences before. We talked off the air, too, about selling properties or houses and that. And someone should talk to their CPA before they sell it so they know what the tax liability will be. Same with making withdrawals in retirement. Where do we pull this money from for our income stream, for a purchase, for whatever it is we want? What makes the most sense tax-wise for the year in which you're going to withdraw it?
Sure.
Unfortunately, people that don't have these 3 accounts, they just have this big IRA, could be $100,000, could be $2 million, but that's the only place they have to get money. So whenever we withdraw from it, they're going to get taxed.
And they get clobbered the way you're
Well, depending on their situation. Oh,
Right.
They could get ugly clobbered. Versus if we had an after-tax account over here or tax-free where we could pull the money from, and then they pay 0 tax or very little.
Sure.
It's huge, and it's a great benefit in retirement to have this flexibility.
Right. Well, that's where a good financial planner like yourself comes in. Hopefully, folks will get in early enough that they can make plans.
Yeah, and we'll talk in the next segment. Yes, and on top of that, they could do something else too, which I'll save.
Okay, it's a good tease. Go to Wayne's website, todaysretirees.com. Todaysretirees.com. We'll be back right after this.
A certified financial planner is a true professional, a well-rounded, holistic planner that helps you in all areas of your financial life. Estate planning, tax planning, financial planning, insurance planning. We have to sit for a 10-hour, 2-day exam, at least back when I took the test. It's not just a weekend designation where you go somewhere for a couple days, pay a couple $100, and now you have letters behind your name. One thing I think is important is that you try and find a independent certified financial planner. Somebody that doesn't work for a big firm. I myself own my company, Great Lakes Benefits and Wealth Management. The buck stops with me, an independent, certified financial planner, one of the only ones on the north coast of Ohio. So we've all heard the word rollover when referring to an investment account at work or your 401k, your 403b, your 457 plan. What do you do with that when you've left your job and your 401k or other retirement plan is still at your old employer? Or what if you've retired? One thing you don't want to do is you don't want to leave your money, your retirement account, in your employer's 401k. Quite frankly, your old employer or current employer is the boss of your retirement account. So if you have questions about what to do with your rollover, you roll it to Wayne. Get it in your own hands where you have the whole universe of investments and choices, not just what your employer tells you can pick from. So contact my office for a free consultation on how to roll over your old retirement account.
And welcome back to today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Today we have been talking about a great topic that all of us love to talk about. We love to sit around and have coffee and just chew the fat over taxes because it's such a pleasure.
I don't mind it. I love it because I like helping people save taxes.
Well, see, that's the thing.
Yeah.
Most people, we have an income, whether we're retired or we're working, whatever. We have an income, and we go every spring to a tax preparing service, and the tax preparing service fills out the paperwork, and they say, you write a check for $3,000, or you're going to get a refund of X dollars, and that's all we think about when it comes to taxes, most of us.
But most do. I mean, we do our discounted tax service for clients, $90, CPA prepared. So, most of my clients, when they go into the tax season, they're not going to be surprised in April, or this year was May, right?
Right.
They, if you stay on top of your taxes, what your tax liability is going to be throughout the previous year. And you should be involved in that process and have the CPA involved. I pay, we talk about pulling money from IRAs and 401ks and that, or selling a property and having a tax, liability when the transaction happens. Well, you should know what that is up front. If we have a client that's going to buy a car and the only account they have to pull from is their 401k, well, that's going to be a 1099 for whatever the withdrawal is.
Okay.
And we have the accountant do a projection what the tax liability will be. Will they bump a tax bracket? Will more tax be charged on their Social Security?
Okay.
How much are we going to pay? And if it's a ridiculous number because your Social Security gets clobbered and you bump a tax bracket, you may want to find another way to buy the car or the room addition or the camper or whatever it is you were pulling the money out of. And like I said in the previous segment, if you did your job over the years and had the 3 pots of money, then we know we don't go to the IRA if it's going to cause us that much tax damage.
Sure.
So, but if you are the person that loaded up your 401k, or you just took a pension buyout and you have this large chunk of money you got that's never been taxed, well, you're stuck. Okay, you could juggle through the years, with home equity lines of credit, financing cars, leasing cars instead of taking big chunks out of IRAs. But it's even more important that you get the CPA involved if that's you, just so you don't.
Sure.
But if it is you, and you have adult kids, share with your kids this issue.
Okay.
Don't just load up 401ks. They should have Roths, and they should have after-tax accounts. When they reach retirement age, they want the flexibility to have 3 different pots of money to plan their retirement with.
Okay.
Not just one pot that's never been taxed.
Sure. So you're telling me to share this with my kids and grandkids to do what I did not do.
Exactly.
Okay. Right.
Exactly, because you were never told. I mean, it's, people, if you weren't working with, certified financial planners through your working years, they're not going to tell you. The Fisher Investments of the world or the brokers out there, they're just going to grab the money and it's what they do.
Sure.
Take your money and invest it.
Right.
But they're not going to help you tax plan along the way.
Right. So the person that is, 40, 50 years old and they've been doing it the wrong way, is there help for them?
Well, if you're 40 or 50, it's not too late.
Okay.
Absolutely. If you're that person that's been diligent, and you're 40 or 50 and you have a big chunk in your 401ks or IRAs, you got to switch. Bite the bullet. Pay the tax now by getting in the Roths, Roth 401ks and such, and after-tax accounts. And we talked about us being in historically low tax brackets right now. So You should be doing that anyway, but
Sure.
it's a good time to switch and start loading up those Roths.
Sure.
For you, your spouse, just get as much money in those tax-free accounts as possible and pay the taxes now on it.
And you can convert those.
Well, that's a different story.
That's a difference. Okay.
So we're talking contributions now.
Okay.
Right? You could also convert. Absolutely. That's a little trickier. So
Okay.
it depends on the tax bracket you're in, but Roth conversions and Roth conversion plans as in financial planning with your planner to come up with a schedule to do Roth conversions,
Sure.
super important, especially if you're the guy that has this big pot of money in IRAs and 401ks.
Okay.
You want to get some into the Roths while you can prior to your required minimum distribution age of 72, so you're not getting clobbered at 72 by the government making you take
Sure.
big chunks and just totally crushing your tax plan.
Right. Wow. Well, friends, this is why Wayne does this program, to teach you and to teach myself, teach the viewers and the radio audience how to better plan for your retirement future. And take his advice and talk to your kids and your grandkids about the IRA and the Roth IRA. And better yet, pick up the telephone, 866-626-3990, 866-626-3990. Make an appointment, go in and sit down with Wayne and let him help you and your family put together a plan that makes sense for you. We are out of time for this program. We'll see you the next time.
A certified financial planner is a true professional, a well-rounded, holistic planner that helps you in all areas of your financial life. Estate planning, tax planning, financial planning, insurance planning. We have to sit for a 10-hour, 2-day exam, at least back when I took the test. It's not just a weekend designation where you go somewhere for a couple days, pay a couple $100, and now you have letters behind your name. One thing I think is important is that you try and find a independent certified financial planner. Somebody that doesn't work for a big firm. I myself own my company, Great Lakes Benefits and Wealth Management. The buck stops with me, an independent, certified financial planner, one of the only ones on the north coast of Ohio.
Thanks for tuning in to today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Visit todaysretirees.com or call 866-626-3990 to schedule a no-cost appointment with Wayne. Today's Retirees is brought to you by Great Lakes Benefits and Wealth Management, family-focused retirement and tax planning services, anchored in family values. Information and opinions discussed on today's Retirees do not necessarily reflect the opinions of this station. Opinions expressed should not be substituted for individualized consultation with a qualified financial advisor. For specific information, call 866-626-3990 or visit todaysretirees.com.